Chapter 13 Options Terminology Part 2. In the previous video, we have seen some of the options terminology. In this video, we are going to continue and see some more options terminology. In the previous video, we saw what is stock options, commodity options, index options, buyer of an option, writer of an option, call option, put option, option price, expiration date, strike price, American options, European options. Now in this video, we are going to see three more terminologies, which is in the money option, at the money option, out of the money option. In the next video, we are going to see what is intrinsic value of an option and time value of an option. Now, as we have seen in our previous video, this particular graph pertaining to the buyer of a call option, which is nothing but a person who holds a call option. So in this example, I was explaining that a particular person wants to buy gold. So he bought a stock option at a price of 28,000. So that is a strike price, 28,000, for which he had paid 1,000 rupees of premium. So this graph represents how the payoff is, means the profit and loss in this particular call option of a gold. So moment a buyer buys an option, he needs to spend some premium. So for that, he needs to spend some money. So in this case, he had spent 1,000 rupees. And just imagine, for example, current spot price, means current price of the gold is around 26,000, but this particular buyer has brought this option for 28,000 as strike price. So as long as the gold remains at 26,000, the buyer is going to be in loss, means he didn't recover his premium money. So this kind of situation where the option can't be exercised in this call option, for example, because the spot price or today's market price is less than the strike price. So this option can't be exercised. So it is called out of the money option, means there is a negative cash flow here, means there is a negative cash outcome if he try to exercise it. So it is called an out of the money option. But in future, if the gold price reaches to 28,000, that means today's market price is 28,000, and the strike price at which this particular buyer has bought is also 28,000, then that scenario is called at the money. When the strike price and the spot price are equal, it is called at the money. Means in this scenario, if a particular option buyer executes, then this is a zero cash flow. There will be neither any cash out of it. It's a zero game. So it's an at the money option. Means the option is almost at the brink of making profit, or it can even go back to the loss. So this is called at the money. So now we will imagine that the gold price has gone to 30,000 and the buyer of this particular call option has a right to buy 28,000. So in this scenario, what happens? If he exercises his right of buying at 28,000, he is going to make a profit. So if that scenario arises, it is called in the money option. Means the option is in green. That means he is going to receive a cash or a profit out of it. It's called in the money option. Now it still further continues during the tenure of the option. For example, we can understand hypothetically that the gold price has gone to 34,000. Still he has a right to buy at 28,000. That means in this case, the investor will have a lot of profit margin. So in that case, usually they call it as deep in the money option. So why this in the money, at the money, out of the money needs to be discussed, because these are the terminologies that a particular in the market they are used. So if a person buys any particular stock option, he should understand what kind of option he is buying, whether the option is in the money, at the money, out of the money, or very deep in the money. So this is the perspective we saw in a call option. So call option out of the money, in the money, at the money, and deep in the money are very much different from put option. Let's see in a put option perspective. Now, this is a put option perspective. Here a buyer bought a put option of gold, which is he paid some premium, 1000 rupees in the same case with a strike price of 28,000, expecting that the market will go down. So here he has a selling right. Since this is a buyer of an option, buyer of a put option, the first thing is, moment he buys this kind of option, he is in loss, because here he spent 1000 rupees to get this option. So he remains in loss as long as the price doesn't come down. So he will make profit if the today's market price goes below 26,000. For example, today if you are in this example, we can consider 30,000 is today's price, but he has bought a put option of 28,000. That means he can sell at 28,000. So as long as the gold remains at 30,000, he is not going to make any profit, but he is in a loss because he paid a premium. So here the gold is around 30,000, so he is out of money. So in future the market has dropped down and the current market price has come down to 28,000, which is same as the strike price or the exercise price of this put option, which is 28,000. So in this scenario, when the strike price is equal to spot price, that is a zero cash flow game in which he neither makes a profit or loss. So this is called at the money. So this option is in a brink of a point where it can get into a profit zone or still again go back into a loss. So this is called an at the money option. Now in future, let's imagine this particular price of gold has gone to 26,000, but still for this buyer of this put option, he has a right to sell at 28,000. That means he will be in a profit. So in a put option, if the price goes down, then the option buyer is going to be make a profit. So in this case, when the strike price is 28,000, which is greater than the current market price, which is 26,000, so this is called in the money option. In the money option. So in future, let's imagine the gold has gone to 15,000, which is a huge margin because the seller has the right to sell at 28,000. But what happened is the current price is 15,000. So in that case, when there is a huge positive cash flow, which is a huge profit, then this scenario is called deep in the money for a put option. So here we can see different stages that an option can be called, how it is, like whether it is an out of the money, at the money, in the money, or deep in the money option. So these are the terminology that you need to understand in the market, because when you buy and sell an option, you should always see what kind of option you are buying. Always in the money option or deep in the money options are more expensive because they are already in profit. But the options which are completely out of the money or deep out of the money are relatively cheap because they are far away from the strike price. So again, if you see in terms of definition, in the money means ITM, they call it in a simple form. When the option is an ITM, it will have a positive cash flow. So it is an in the money. For example, a call option, always the spot price means today's price should be greater than the strike price. Then it is in the money. Same with the put option, if it is in the money, when spot price should be less than the strike price, then it is called in the money for a put option. At the money is nothing but when the spot price means today's price is equal to the strike price at which the buyer bought, whether it might be put option or a call option, it is called at the money. It is a zero cash flow game. He will neither make a profit or loss. And out of the money is a scenario where he will have a loss. The option buyer will have a loss at least to the amount of premium he had spent. So for a call option, if the spot price is less than the strike price, that means the buyer of an option is going to lose his premium. So he will remain in out of the money. For example, in a put option, the spot price should be greater than the strike price. Then he is out of the money. So OTM, ATM and ITM are three ways of calling an option in a short form. So in this table we can see when a call option and put option goes to in the money, at the money and out of the money. So in the money, spot price should be greater than strike price for a call. For put option, it is the opposite. Spot price should be less than the strike price. At the money, for call option, spot price is equal to strike price. That is same to the put option. And then out of the money, spot price should be less than the strike price for call option. And for put option, spot price should be greater than the strike price. So in our next video, we will continue with our option terminology. In this video, we have seen in the money, at the money and out of the money options and the terminology pertaining to it. So in the next video, we will see some more terminology. You can like or comment on this video in the YouTube channel. You can even subscribe. You can click the bell icon to receive notification for all the future videos so that you would not miss. For feedback, you can also write to demystifying.derivatives@gmail.com. Thank you.